Last month we asked if this is as good as it gets. Certainly since then, we've seen a slightly softer flow of data, and there's been some slippage in the economic surprise index. I think there's no big fears over growth, it's just that it's hard to find a candidate for incrementally positive news. We've got more of a concern over policy. Okay, monetary policy tightening is going to be gradual, but it is going to be faster than the markets expect. I think the Fed will hike again in June and in September. I think we're more worried by policy. Trump's first 100 days in office yielded little. He's pushing for tax cuts, but it's hard to see genuine reform. Maybe they're going to increase the deficit through lower tax rates. They're already low in America, but that's not much help when you're at full capacity already. It would just mean higher deficits and pressure on the Fed to raise rates faster. So far, protectionism has been happily absent, but of course, if deficits go up, that might change. So overall, no great worries, but it does look as if this is as good as it gets.
This month saw two changes in asset allocation, driven by some increased risk in one area and a decline elsewhere. First, the decision was taken to upgrade European equity from a small underweight to neutral. After the first round of the French elections, the overall level of event risk has receded to the point that the underweight stance was no longer necessary. New elections in other regions of Europe are some way off and will be scrutinized closer to the time. For now, the risk of a euro breakup has drifted into the background. Furthermore, in a world of stretched valuations, Europe has lagged behind. Also, its growth outlook is stabilizing, and the ECB is under absolutely no immediate pressure to reverse its very accommodative monetary stance anytime soon. Secondly, with inflation slowly seeping back into the system, we maintain our call that the Fed will keep hiking rates through 2017 and that there will be some upward pressure on the longer end of the interest rate spectrum. The best way to express this in portfolios is to reduce to underweight the exposure to high-grade, developed market fixed income to underweight. It is the most rate-sensitive asset class in the asset allocation framework and an easy choice to underweight if rates pose upside risk. Note that the view on credit is still benign. Given the supportive backdrop from the economic picture globally, EM and high-yield credit still look fair value. In fact, it is driven by strong flows from investors, as evidenced by record-high new issuance in this year so far. This helps firms to do a lot of refinancing. Overall leverage in the sector is well contained, and defaults likewise. No other changes were implemented this month. We continue to have an overall cautious stance in our asset allocation. We have not moved the weights of any of the other equity regions for reasons of valuation.